Welcome to Invest and Learn podcast. We are VORUM and we will help to transform your investment journey into gold. With me, Fauzan, your main host, and we'll unpack William O'Neill's How to Make Money in Stocks. Joining me, our four financial experts, Ambang, Rangga, Age, and also Ferlan. Together, we'll explore O'Neill's principles and actionable insights to shape your financial future. Let's dive in.
That's right. O'Neill Canceling is a game changer for identifying high growth stocks. It's a powerful framework that anyone from beginner to experienced investors can use.
And don't you worry if you are new to investing. We will breaking it down into a simple and relatable steps with plenty of real-world examples.
Plus, we'll dive into the psychological of investing, common mistake to avoid, and tools you can use to start today.
Let's get started, Fauzan and Ferlan. Take it away with the first part of the canceling system.
Let's start with the backbone of O'Neill's book, The Canceling System. It's an easy-to-follow 7-step approach to identifying high-growth stocks, and trust me, it's a game changer for investors at any levels. Each letter in Canceling represents a key factors in finding winning stocks. I'll tackle the first letter, the C, A, and N.
And I'll cover the rest, S, L, I, M. Let's dive in.
C. Current quarterly earnings. O'Neill tells us to look for companies with at least a 25% increase in earnings compared to the same quarter last year. For example, the Nvidia's earnings during the AI boom skyrocketed, making it clear for growth leader. A. Annual earning growth. Focus on companies with 25% plus annual growth over 3 to 5 years, like Tesla in its early days with consistent, strong expansions. And new products, service, or heights. Apple's iPhone launch is a classic example. O'Neill highlights that industry leaders often bring something new to the market.
S, supply and demand. S focuses on supply and demand. Stocks with fewer shares and high institutional buying trend to perform better. For instance, limited shares in growth companies like Shopify often drive their price up. L, leaders or laggards. L is about picking leaders, not laggards. Use tools like relative strength ratings to find stocks outperforming their peers. E, institutional sponsorship. E stands for institutional sponsorship. Looks for stocks backed up by big players like mutual funds or pension funds. Their buying power often drives price higher. And the last one is M, market direction. Finally, M is market direction. Always align your investment with broader market trends. O'Neill use tools like the following through day to confirm when markets are shifting from bearish to bullish.
And that's the canceling system. Now, let's dive deeper with our data expert, Age. Take it away from here, Age.
Okay, thank you. Now we will discuss about timing and market trends. Timing is everything when it comes to investing. O'Neill emphasizes that even the best stocks can fail you when you buy it in the wrong time. This is why understanding market trends is so important.
You know, I like what you've mentioned there, Age. Even a solid investment can be a missed opportunity if the timing is off. So, how do we know if the right time is to invest?
It's really a great question, Fauzan. One of O'Neill's tools is follow through day. It is like a green light for investor. It's like occurs when a major index like S&P 500 or Nasdaq rises significantly on higher than average volume, signaling institutional investors are re-entering the market.
Nice. Can you give us an example how this works in real life?
Sure. Let's look at the 2020 market trends, recovery after the COVID crash. The market had been in steep decline, but by late March, there was a follow-through day. That was the signal for many investors to start re-entering the market. If you waited for that signal, you could have avoided deeper losses and positioned yourself for the bull run that followed.
But what happens if you ignore the market trend?
Ignoring trends can be like swimming against the current. Imagine buying stocks heavily during a bear market, thinking you're getting a bargains, only to see them drop even further. You lose both capital and confidence. It is why O'Neill says aligning with the market is very critical.
That's powerful analogy, Age. But how can investors spot this trend on their own?
Start tracking the indexes, major indexes like S&P 500. Use tools, platforms like Yahoo Finance or TradingView to monitor their daily movement. Look for higher trading volumes and significant upwards move. Those are the clues that market might be turning bullish.
That makes sense, Age. It's like waiting for the tide to turn before setting sail. You want to move with the momentum and not against it.
Yeah, so the patience and observation are your best tools. Don't be like FOMO, control your decision.
So let's talk about common pitfall and investing psychology. Investing is as much about understanding human psychology. O'Neill highlights that many investors fall into emotional traps, which can be quite costly. Let's discuss one of the most common pitfalls, holding onto losing stock.
You are correct. I've definitely been there. You buy stock at 100, but somehow down to 80, right? But you keep thinking it will be bounce back. What does O'Neill suggest we do in this situation?
So he advised cutting your losses early, specifically when the stock falls 7 to 8% below your purchase price. So if you bought at 100, you should sell if it hits 92. It might hurt initially, but it protects your capital and prevents from being stuck in a losing position.
Letting go of losing stock is very tough. How do you get past that mental hurdle?
I think discipline is very crucial here. Set your stop loss rules before you even buy the stock and adhere to them. Think of it like wearing a seat belt. It might feel restrictive, but it can save you from a crash.
What about overtrading, Rangga? That's another big mistake, right?
Correct. Overtrading often stems from FOMO, the fear of missing out. Investors hear about hot stocks and jump in without doing their homework. This usually results in more losses than gains.
That's a great point. Emotions can easily take over in investing, whether it's FOMO or panic selling. So, how do we keep that discipline and avoid overtrading when there's so much hype around the next hot stocks?
Focus on quality over quantity. Stick to one or two stocks that can meet the can-slim criteria. Avoid chasing trend without a clear plan.
Any other psychological pitfalls we should watch for?
Impatience is a big one. Investors often want quick wins and end up selling good stock too early. O'Neill reminds us that the stock market rewards patience and long-term thinking.
So, the key is to stay disciplined, stick to your strategy, and keep your emotion in check.
Correct. Investing is a marathon, not a sprint. The more disciplined you are, the better your result will be.
Now we deep dive to the learning from history. One of the most fascinating part of O'Neill's work is how he studied over 100 years of stock market history. He wanted to understand what made certain company market winners. His conclusion, the best performing stock often share common trait before they become household names.
Ambang, that's such a powerful idea. Studying what made them great so you can build your own winning lineup. Can you share some examples of these traits in action?
Absolutely. Let's start with Amazon in the early 2000s. Back then, it wasn't the e-commerce giant we know today. But if you look closely, you would see explosive earning growth as it started to dominate online retail. Investors who spot those traits early made massive gain.
It's amazing how Amazon wasn't just a retailer, it became an innovator. Are there other examples like this?
For sure. The other example is Microsoft in the late 1980s. It's another great example. At that time, the personal computer revolution was just beginning. Microsoft had the right product, Windows, and it dominated the operating system market. Its consistent earning growth and leadership in tech made it an obvious choice for investors.
So this company had explosive growth, but they were also innovator in their fields. Is that a pattern that O'Neill's emphasizes?
Exactly, Age. O'Neill found that market winners are often industry leaders who are doing something new, whether it's introducing a groundbreaking product, entering a new market, or adopting an innovative business model.
That's interesting, Bapak Ambang. But what about spotting future winners? What lesson we can apply today?
The key is to look for the company with similar traits: strong earning growth, market leadership, and innovation. For example, Ferlan, in today's market, you might look at company leading in AI, renewable energy, or biotechnology. O'Neill works remind us that by studying the past, we can identify opportunity in the present.
So it's not just about picking stock randomly, it's about recognizing the sign of potential winner based on what worked before.
Yes, and that's why O'Neill stresses that importance of doing your research and staying informed is all about being prepared for the next big opportunity.
Ambang has a good point. Now, let's get practical here. Stock screeners help you find hidden gems by filtering stocks based on earning growth, institutional backing, and also leadership. Use them effectively to invest smarter, not harder.
That sounds helpful. Do you have favorite platform?
Definitely. I love using Yahoo Finance and also Morningstars because they are perfect for beginners with their easy to use free tools. And if you're looking for something more advanced, MarketSmith is also a great option. It's built specifically for the canceling system.
That's a great tip. What about timing, Fauzan? How can tool help us identify market trends?
You know, Ambang, timing is everything in the market. Tools like TradingView and Thinkorswim help track price patterns, market indexes, and also key signals like follow-through days, your signals that it's go time.
What about staying disciplined, Bapak Fauzan? Any tools to support that?
Yes, of course. Think of it like keeping a fitness journal, but it is for your investments. A trading journal is your accountability buddy. It's a simple habit, but it can seriously level up your strategy.
Okay, so Fauzan, the takeaway is to leverage tools like stock screeners, charting platforms, and trading journals to make more informed decision, isn't it?
Now you got my point, Age. And don't forget to stay curious. Continuously learning is a key success in the investment.
Now, let's talk about the big picture. Having a long-term perspective. O'Neill reminds us that building wealth in the stock market isn't about overnight success. It's about staying the course through market cycles.
That can be tough, Age, especially during the market downturn. What O'Neill advice for staying disciplined?
He emphasized sticking to your rules, like cutting losses and taking profit at 20 to 25%. For example, if you invested in Apple in the early 2000s, held onto it through ups and downs, you will have seen extraordinary return over time.
That makes sense, Bapak Rangga. But what about dealing with emotional side of long-term investing? Watching your portfolio fluctuate can be nerve-wracking, you know.
It can be, but that's where mindset comes in. O'Neill advises focusing on bigger picture, your long-term goals, rather than short-term market noise. Having a clear plan and trusting your strategy can help you stay grounded.
Absolutely. Market dips and spikes are just part of the journey. If you've got the right strategy and foundations, you can trust that growth will come with time.
True. The rewards come to those who stay patient and consistent.
Wow, we have covered a lot today. From the CanSlim system to market timing, psychology, historical insight, tool and the importance of long-term mindset. O'Neill book really is a masterclass in investing, I guess.
Correct, Bapak Ambang. The biggest takeaway for me is how everything ties together. CanSlim is not just a checklist, it's a holistic approach to finding and managing great investment. Being disciplined is also important, whether it's cutting loss, timing the market, or holding on to quality stocks. Staying consistent is the hardest part, but it's also most rewarding.
Yeah, I love the historical example. Learning from the past winner like Amazon and Microsoft give you a blueprint for spotting future opportunities. And don't forget the tool, stock screener, charting platform, and trading journal make it so much easier to apply O'Neill principle in the real life.
Correct. To our listeners, if you enjoy this episode, please like, share, and subscribe. And let us know in the comment what is your biggest takeaway from how to make money in stocks.
Thank you for joining us on the Invest and Learn podcast.
Until next time, happy investing!
And that's a wrap for today's podcast brought to you as part of corporate financial class at IMI Institute. Thank you for listening. Goodbye.